Now, it never gets too old talking about startups, does it? Everyone wants to know what that key is to what it takes. I only wish there was one and I had it. Up next, we have a panel to deep dive into the fascinating facts of startups for founders and for bursting any of those venture capital myths. To lead the conversation, I invite Vidyut Parakh, a board member of the IIT Bay Area alumni, as well as the president-elect at IIT Startups. He's an IIT Kharagpur alumnus and veteran of many successful startups such as Xanda, Corel, Cortina Systems, Rombi, and Transwitch. Having co-chaired cohorts 5 and 6 for IIT startups, he has intimate knowledge of struggles of entrepreneurs trying to get companies off to a good start. Take it away, Vidyut.
Thank you. Thank you, everyone. I would like to present a couple of slides to talk about IIT startups, and then we can go into, oops, wrong one, stop share. One sec. All right. What's going on here?
Take your time.
All right. Yeah, I'm getting this. Okay. So hello, everyone. I'm Vidyut Parakh, President-elect at IIT Startups. Today, we'll be doing a deep dive into the myths of venture capitalists. First, allow me to introduce IIT Startups. IIT Startups is a nonprofit startup accelerator dedicated to helping founders get their early-stage companies off the ground. We take no equity and use cohort-based shared learning. We assume, as we have heard over and over from the panelists before, that IITians know their tech. So we instead focus on topics such as product market fit, go-to-market strategy, sales playbook, and customer buying process. Founded in 2018, we have had 6 cohorts consisting of 71 companies, 6 of which have already been acquired. We are in the middle of cohort 7. The demo day is scheduled for January 2022. We are looking for founders and mentors for our next cohort. Please sign up at our website. We have 2 very experienced VCs with diverse and hopefully different views for our panel today. Both focus on early stage investing. We have also reserved some time at the end for questions from the audience. Please send me your questions using the Q&A tab. First, we have Nilanjana Bhaumik, founder of Converse VC. Nilanjana, please take 2 minutes to introduce yourself and the fund. And please add Nilanjana to the panel.
Well, thank you, Vidyut. I'll get started. Can you hear me?
Yeah, I can hear you, but you're not spotlighted yet. So please.
Well, I'll get us started. Well, good morning, everyone. It's a real pleasure to be here today. I am a computer science major from Roorkee from many years ago, and so it feels like I've come full circle with this panel today, and feels like home. Very quick background on myself. I started in the tech industry at an object-oriented database company that was based in Boston. A very fast growth company, took its first money from NEA and went public within 4 years. And that was an eye-opening, exposure to what happens, how chaotic but exciting growth can be. And that's how at age 27, I ended up running the solutions business, entire solutions business for a public tech company. And those are the types of opportunities that open up when a company is growing really fast. From there, I went to what was at that time the premier tech investment bank called Broadview. Broadview today is the tech investment banking arm of Jefferies. And at Broadview, we did only M&A for tech companies. And so my job was sort of, getting private companies sold or helping public companies buy companies. I happened to join Broadview right before the tech bubble burst. into 99, and I stayed through the entire crash of the market. And that was a very different experience from object design in, it just seeing firsthand how financial value gets created in tech companies, and sometimes how ephemeral that value can be if the capital markets dry up. So, a company that was valued at a $300 million valuation 2 weeks ago, I had to transact at 40 million, 50 million, and explain to the VCs that that's where the market was. A very different but excellent perch of the market, top down, and really seeing tech sectors emerge, et cetera. From there, I went to an early stage venture-backed venture firm called Longworth, also Boston-based. We were B2B investors. I was a GP there for many years doing enterprise tech investing. And then a few years ago, I started a new venture firm with another co-founder, Maya Heyman, called Converge. And the principal reason for starting Converge was because Maya and I had been in the tech industry for a while. And what we were seeing was a seismic shift in the industry. We were convinced that we were sort of at the cusp of a completely different industry that was morphing. And the next 30 years of value that was going to get created in this tech industry was going to be nothing like the past 30 years. And so it was time to take a clean sheet of paper and create a firm that was really forward-looking, modern, and built for the times. And sometimes you have to throw the old rule book away and create a new set of rules. And that's what we are doing with Converge. It's been an exciting journey. We're about to activate our third fund. We are early stage investors, and we are quite sort of flexible and nimble in how we invest. So if you're a founder, from your point of view, we are very flexible with our check sizes. We can invest a few $100,000 up to a few $1 million in your first round. We are typically first round investors. We are very happy going pre-product. We are also happy coming in when you have, the first set of customers in your viewpoint. We love deep tech, but at the same time, we are also very excited about, applying digital transformation to old laggard industries like oil and gas, construction, what have you. Our companies are based geographically very diverse. We have investments all across the US, in Canada, in Israel, selectively in Europe, and maybe at some point in the future also in India. So I'll hand it back to you, Vidyut, and wonderful to be here today.
Thanks, Nilanjana. Ashmit, next we have Ashmit Sidana, founder of Engineering Capital. Ashmit, please take 2 minutes to introduce yourself and then dive into the first myth you want to talk about.
Thank you, Bilyot. It's a pleasure to be here. One of my favorite audiences, which is, of course, all the folks from IIT, because I'm an engineer. I love engineering, which is also why I call my firm Engineering Capital. I came to the Bay Area, to Silicon Valley, to study engineering at Stanford. I did computer science. And I have watched Silicon Valley go from this quirky outpost when we were really a side show, including in venture capital, where Boston was really the hub for venture capital, to becoming this very hot .com boom, and then the crash when everybody went away. And now again, we've got this resurgence where Silicon Valley seems to be at the heart of not just the technology world, but entirely all the businesses in the world being transformed for it. I run Engineering Capital, which is a seed stage venture capital firm. And I call it Engineering Capital because it is venture capital for engineers, investing very early in companies that are taking technical risk. Believe it or not, most technology companies don't take technical risk. They mostly take market risk. And if we have time in the Q&A, we can dive into the differences between market risk and technical risk. But I know Bidyut is eager to get started with the myths. So maybe I should switch to that, Bidyut?
Yes, please.
Okay, wonderful. So the first myth that we're going to talk about is that a VC's job is to help you. A lot of people believe this, and this is a myth, which of course VCs love to propagate. We love to talk about how we're going to help you, what we will do for you. But let's understand who a VC is and what their real job is. So first, let's define VC. VC has become this sort of ambiguous term, especially more recently because we have firms like Tiger Global, Coatue, hedge funds investing, Fidelity, a mutual fund investing in venture. Just this week, we had Sequoia Capital restructure themselves into an RIA, a registered investment advisor, not what you would call a VC. In fact, legally, technically, they are no longer a VC in the government's books because they are an RIA. But I would still call them a VC. And here's how I'm defining VC. A VC is someone who takes very high risk, technical, market, consumer, whatever type of risk, and comes in early. Early means before it is obvious, before you can just look at the numbers, look at a spreadsheet and say, aha, this is going to be a business that I can analyze on conventional financial terms. So that's a VC by my definition. I want to be crisp about it because we will get into some of the myths and there can be a lot of ambiguity about it. So now let's say we've got this VC, you've got someone like Nilanjana or myself or any of the other, hundreds of venture capital firms who want to work with you. And you may think that our job is to help you. That's not actually true. The number one job of a VC is to invest money. We are investors and we are viewing everything through the lens of, is there a capital return to be made over here? As a part of that, we may take a governance role, serve on your board. We may be buying an option to invest more money in the future, which is often what large firms are doing these days. They are making small investments, sometimes even $10 or $20 million, with the hope of investing $100 or $200 million in subsequent rounds. So you have to be very careful and understand what exactly is the role of the person you are working with. Their job number one is to be an investor, to make money for their limited partners, and that's what they're doing when they're working with you.
Thanks, Ashmit. Nilanjana, you want to add something?
Yes, I think that's very well said. I think role clarity is very important, right? Role clarity within your organization and role clarity in your board, in your investor base is important. And I think Ashmit did a tremendous job on clarifying what is the principal role of your investor. Having said that, they're not successful if you're not successful. So in the realm of their participation in your company, to the extent that they can, they do need to help you. Because if you, on the other hand, we'll talk about the word help later, perhaps. It is ultimately your job to succeed and build a successful company. And so you can leverage your investors and your board members to further that goal. And they do have, many aspects of the business where connections, knowledge, insight, et cetera, which we'll talk about later, where you can leverage it. So while their principal role is not to help you, they are a resource that are available to you that you should use.
Okay.
Really well said, Nilanjana. We can't win if they don't win. So we that's why we are incented to help you. I love it.
Yeah. It actually will be great to talk about how you can leverage them later, and I will ask you a question on later. Okay. Let's go to the next myth. Nilanjana, you want to start off this time?
Right. Now, this one is truly a myth, which is a VC will actually tell you why they passed. Both Ashmit and I have been in the business a long time. Very, very seldom may a VC actually tell you why they passed. This is for many reasons. We are in a relationship business, okay? And a founder's company is their baby. And many times VCs, whatever the reason may be, will finesse why they passed because they're really sort of, afraid that you will be offended, that you may not like why they passed. So VCs tend to finesse why they passed. They will seldom tell you why they passed, and you should just take that under advisement. Now, does that mean, what does that mean actually to you? My personal view is that this industry just has changed so much and has become such a volume business from every perspective, volume of companies, volume of investors, that don't get too hung up on why any one particular VC passed. My advice always is, look, you got to talk to a bunch of people and see what the market is telling you. If the market collectively is saying no, then you got to analyze it at some level and, do A/B testing, do change your pitch, change your team. It's market team usually at that stage. And just look at sort of statistically what's the market is telling you, and then come to some conclusion, come to some adaptation, but don't get too hung up on any one VC's yes or no analysis. Ashmeet, over to you.
Thank you, Nilanjana. You started with a great point that this is fundamentally a relationship business. And so VCs are not incented to tell you why they are passing when they pass. And that's why you get into a lot of, confusing conversations with VCs where you will either get flimsy reasons or made up reasons why firms are passing. Occasionally, people will tell you, and there is something that can be learned even when the signal is very flimsy. By talking to a lot of VCs, you can pick a signal out of that. All of us who have done statistics, we are good engineers, know that you can get tremendous signal out of a lot of noise if you get enough data points, but you need a lot of data points to really get that learning. Even equally importantly in this myth, it's important to understand, why do VCs actually pass when they pass on your company, right? There are two fundamental buckets that you can put a reason to pass into. The first bucket is that they don't think it's a good investment. And that's really what most people jump to, because they think it's not going to work. The other reason is it's not a match for what the VC is doing. VC is a highly specific asset class. Every firm has a different strategy. These strategies vary widely based on what stage they want to invest in, what sector, what type of founder they're building. We are building very concentrated portfolios. The average venture fund only has 20 or 30 companies in it. In terms of an individual fund. And so a VC may be looking for something very specific, and often it's just not a match. When VCs say that they are early stage, they might mean that they are investing, in companies which are doing at least 50 million in revenues. That would be defined as early stage if you're sitting in Wall Street in New York. That would be an early stage investment. We would laugh at that as a seed stage investor, or perhaps, by the definition, the popular definition of early stage here in Silicon Valley. So, it's important to understand that many times why a VC is passing is because it's not a match, not because they have actually come to a genuine conclusion on the quality of the investment. And this is a second cause of great, relationship damage, which happens between VCs and entrepreneurs. And so understand, often the reason for a no is simply because it's not a match. And there's no signal in it. There's nothing to learn if it's not a match for what they're doing. It means you have to go find a different investor for whom where you are, what you're doing is a better match for their strategy.
Okay. I actually had a question in this one, and I've come across as my, role at IIT Startups many times, talking about it not being a home run. Is not being a home run a good reason for VC to pass? Actually, it's a great business. You make money, but it's really not something which is going to grow really large.
Yeah. Yes, that is a great reason for a VC to pass for many firms, because you have to understand that one of the common threads in many venture firms is that we are in that very small fraction of the investing universe where we are looking for very high returns for which we are willing to take very high risk. Many companies don't fall into that profile, regardless of stage or sector, etc., that a company may be. You just may not have a high enough risk reward profile. In other words, you may not have the potential to be a home run. And this is another reason why often there is a misunderstanding between entrepreneurs and VCs. For us, often it is better to take higher risk in the hope of getting higher reward, as long as on a risk-adjusted basis, we are getting a higher reward. That is not necessarily what a company may be looking for, or an entrepreneur may be looking for. The classic test for this is the simple thought experiment that I will propose to you. We are all engineers here, so here's the simple question. If I told you that you have two choices, I can give you $1, 100% guaranteed, you can just take the dollar if you want it, or I'll give you a 50% chance of getting $3. Which choice would you make? Any good IIT graduate will tell you, I'll take the second choice, because a 50% chance of getting $3 is $1.50 risk adjusted. And so it's a better choice to make that. Now, let me change the question for you. And here's the magic. I'll give you guaranteed $10 billion, or I'll give you a 50% chance of $30 billion. Which one would you take? So in the second question, if on a 50% chance you get $0, on a 50% chance you get $30 billion. In the first one, guaranteed you get $10 billion. Most people on this call, I would be willing to take a bet on, would take the first choice. What changed? The math is identical. The math is exactly the same, but your choice flipped. And the reason is that as human beings, we have a utility curve, we have a risk reward ratio, and our choice changes based on the risk. By the way, Jeff Bezos may still make the choice for the second one because 30 billion is still a rounding error on his net worth, right? So this is a reflection of your own net worth, not a reflection of the mathematical or the statistical choice being made. VCs are choosing the second choice every time, and sometimes entrepreneurs are choosing the first choice, and that is why you get this sort of misalignment and confusion that happens.
Nilanjana, do you want to add something, or shall we move on to the next myth?
I think let's move on.
Yeah, okay. Next myth was actually Pradhan Ashmit. So you want to take the next one on?
Yeah, this is a great one. And this builds on the previous myth that Nilanjana did such a nice job of describing, where VCs will tell you why they passed. And this is how I describe a myth. The myth is that if a VC turns you down, that means you did something wrong. There's something wrong with the company. And sometimes I'll get an email from an earnest, thoughtful, hardworking entrepreneur who'll tell me, what can I do better? What did I do wrong? What's bad about my company? The answer is often nothing. There's nothing that you did wrong, or just the fact that I'm passing doesn't tell you that there was anything wrong, because we may have passed because it's not a match. It's not a fit for the strategy that fund is following. And so this is a real myth, which again causes a lot of pain to entrepreneurs. Now, that's not to say that nobody ever does something wrong. I have had my share of painful pitches that I have had to sit through. And we all have, as VCs, suffered that. And entrepreneurship is about learning. It's about improving. It's about changing. And so there's a lot you can learn. And I'm not in any way implying that entrepreneurs should not be learning or keeping an open mind, or not even that you should not be asking this question, because sometimes you will learn something from a VC who has seen, hundreds or thousands of pitches and worked with perhaps tens or hundreds of companies in their career. So it's a very different experience base, and there is something to learn. But again, just because they've turned you down does not mean that you are doing something wrong. It just means it's not a match.
Yeah, let me maybe add a slightly different nuance. So all of that, agree 100%. Just talking about more on the theme of structurally what's changing in the industry. One, if you are going to be a successful entrepreneur that will raise external money, take venture money, take growth money, et cetera, then that itself has to become a core part of your skills. Okay, so you may be a very talented engineer, you may be a very talented people manager, but if you can't raise money, you're not going to go as far as your company could have gone. So I do think you need to pay attention to what the market is saying. If the market is big and the idea has strong legs to it, then if you're having trouble raising money, you do have to go to school. Okay, you have to do everything that you need to do to understand. It may be from, back channel, back to the VCs. It may be from, data point analysis. Is how do you get better and better at raising money? Our industry has become about a winner take all market. Okay, the companies that can raise a ton of money are getting ahead, and the ones who may be equally good but are not able to raise money are getting left behind. So this has become a core skill. And I think, all founders need to pay a lot of attention to it and really think of that as a muscle that they need to build from day one.
Thanks, Nilanjana. Maybe you can add a little bit on what you mean by back channel. There's a lot you can get from back channel, and that's actually worthwhile discussing.
Yes. I think the back channel, a lot of it is just sort of relationship building. And, it may be a partner at a firm, but you may know a friend who's a portfolio company backed by that partner. You may know somebody who's a junior member of the team, but it's a lot of work. But that is part of the game. And you just have to go to school and find out, okay, how do I get some, information from what actually happened? It's possible to do it. It is ultimately a relationship building business. And one of the ways in which you learn how to raise money is increasing your relationship network. I mean, that's really how the game is played here.
This is such an important point, Birut, that I'm going to jump in and reinforce why the back channel is so important. Again, just to complete the description, the back channel is when you go and ask someone else for feedback, either through a relationship, through a trusted intermediary, through a confidant, perhaps in a different forum and at a party, in a different occasion, etc., to say, okay, why did you really pass? Or what did you see in my presentation that I can do better? Or what do you think of this other, strategy that I described over there, etc.? Okay, those are the kinds of questions that you want to ask in a back channel. And this is one of those rare cases where hearsay is actually better than the direct information, the direct feedback that you will get. Because of those perverse incentives that exist in this being a relationship business, sometimes what people will tell others is the truth. The keyword is sometimes, not always. You always have to calibrate. You always have to make sure that you're getting it. But sometimes, in fact, many times, people will tell the truth and they'll say, you know what? I like the business, but he didn't do a good presentation. And I'm not confident that he can raise money, enough money long-term to win, which is a previous point that Nilanjana was making. Raising money is an essential CEO skill. Hiring people is an essential CEO skill. Doing great presentations is an essential CEO skill. Selling is an essential CEO skill. And if you don't have some of these skills, a VC may pass on the opportunity, and you may be able to learn that by going through a friend, by going through a confidant and saying, hey, find out what did they think of my presentation? What happened?
Thanks, Sushmit. Thanks for that adding. Nilanjana, take on the next one, next myth.
Well, the next myth is that VCs are very rich. I'm looking at this myth and thinking, is that really a myth? I consider myself very rich, Ashmeet. So I don't know about you.
Well, we are all, most of us are here from India. So, we define rich in a very different way.
Exactly. How do you define rich? That's right. So maybe I'll take that one, and then I want to hear what you think, Ashmeet. But I do think that this is probably, I've done only 3 different things in my career, but this is probably the most rewarding career I've had in many, many ways. And how do I define life richness? Life richness is, this is a profession that sort of feeds my perpetual curiosity perpetually. So if you're intellectually curious, this is a wonderful, wonderful profession because you're always at the cutting edge of new things and meeting continuously smart, energetic, ambitious, driven people. And that is another source of energy that just sort of feeds my energy level. So, that increases my wealth and well-being. And then I'd say, we talked about this relationship business, and I think there's a myth coming up later, but a lot of deep relationships have formed over the years because of this profession. So yes, I consider myself very rich. Now, the fact I'll add is that for us as VCs to stay successful in this business, we have to deliver the numbers. And those numbers are monetary numbers. We have to make money in sort of multiples of fund level for our investors. If we don't do that fund over fund, then we go out of business. And so, so it's not an easy job. It's a hard job. And in that process, we make other people, through you, successful founders, we make our LPs very rich. And so that would be my answer. Ashmeet, curious to hear what you have to say.
Yes, Nilanjana, you took this in such an interesting direction. I love where you took it. So let me start where you were, which is, we come from India, and just on that very crass, simple way, we are all rich over here relative to, I think, the way it is in India at many levels. And again, I'm doing a gross generalization over here in terms of doing it. But there's a more subtle, a narrower way of thinking about this, which is also very important for an entrepreneur to appreciate if they're going to work well with a VC. VCs are in the investing business. It is a very lucrative business. And yes, you can become very wealthy doing it, but not as wealthy as if you are truly a successful entrepreneur. There are very few billionaires who are VCs. there are many entrepreneurs who are truly billionaires, right? Not just billionaires, deca-billionaires, 100 billionaires. Those are all mostly entrepreneurs who made it over there. So you must understand that when a VC invests in you, they are imagining, at least if you are successful, that you will get richer than them in that transaction. That is a good transaction for a VC. That is an interesting dynamic for you to understand and appreciate in how richness or money, because this is a money business, is being evaluated and how those decisions are being made. So that's why I put this up as a myth and something for people to understand, that the role should be reversed relatively quickly in the life cycle if that is going to be a true success in the definition of a VC. The founders of Google, they took money from Sequoia Capital, arguably one of the best venture capital firms. I'll put venture capital in quotes because legally they've just become not a venture capital firm. But obviously one of the very, storied, esteemed, respected venture capital firm. And the two founders, Larry and Sergey, are very, very rich. And they became very rich in their late 20s, early 30s. Much richer than the average partner, even at Sequoia Capital, much less the average partner at an average venture capital firm. And it's important to understand that dynamic in terms of how you work with VCs.
I want to just add to what you honed in on, Ashmeet, this whole, how VCs look at wealth creation vis-a-vis the founder. Okay, so as Ashmeet said, at every company that we are evaluating, it is that dynamic. Is this an opportunity where this entrepreneur will be wildly successful? Okay, so it is anything. Our mentality is anything but a zero-sum game mentality. Okay, so our mentality is the opposite of zero-sum game, which is we want to align our incentives all through that journey, whether it's capitalization at every round, whether it's dilution to the founders, and how do you make up for dilution? Because we are continuously want to make sure that there is full incentive for you to become wildly rich. Okay, it is only if you are making a lot of money in that company, in that deal, in that transaction, that we will make some money. All right. So this is another important dynamics to understand, is that the VCs and your alignment is perfect, and they're incented to have you make a lot more money than their particular fund will do in that one transaction.
All right.
If you want, we can even put some numbers on it, because I think that really makes it sort of, hit you in the face type of thing when you really put the numbers out. And I encourage entrepreneurs to write these numbers down when I make an investment, when I talk to them. And if sometimes they're not even willing to be intellectually honest about it. If you want to make $1 million, getting a good job is great. If you want to make $10 million, getting a great job is great. Those are good paths to get to that. If that's your career goal. If you want to make $100 million, it's really hard to do that in a job. But you can do it as an entrepreneur and still not even be remembered as a great entrepreneur. In other words, I know entrepreneurs who have made, order of $100 million who will not be remembered as, the iconic, great, amazing, the Jeff Bezoses or the Steve Jobs or the Mark Zuckerbergs of the world. If you want to make $1 billion, pretty much that's, your only path, pretty much. Again, I'm doing gross generalizations over here from my vantage point over here as a Silicon Valley investor. And so you as an entrepreneur really need to be thinking, is that what I'm really interested in? Is that what I really want in my life with all the trade-offs that come with it? Of course, if somebody gave me $1 billion for free, I'll take it all day long. I'm not stupid, right? But the question is, are you willing to make the trade-offs that come when you are really shooting to make 100 million, $1 billion, those types of numbers? Because if you're going to make trade-offs where you want to walk away with 1 or walk away with 10 million, that's a different set of trade-offs, and that's going to lead to stress and not a great relationship with the VC.
Thanks, Ashmeet. You want to take on the next myth?
Yeah, this is a good one, and we can probably knock it out quickly because, there's some evidence that this may no longer be a myth in terms of, when I started talking about this. Traditionally, venture was not a good business. On average, venture capital firms lost money. The average venture capital firm had a negative return. and the average GP, the average general partner in a venture capital firm, had a negative track record. This was historically true for a long time in venture capital. So, then you're going like, oh my God, what is this thing? I mean, all the things I said, but notice I used the word average when I was describing these things. And there are some really good case studies and good reports. I mean, the Kaufman Foundation has a very good report on this, where they've done 20 years of statistical analysis, et cetera, on it. More recently, in the last 5 or 10 years, we've seen very good returns in venture capital. And so maybe there is a structural change, and we will see long term, depending on how we define venture, being a good return. But I will end by saying that in general, be careful if you are investing in venture capital. Just because somebody gives you an opportunity to invest in a venture fund, it is high risk, can be high reward, but is definitely not guaranteed. And so you should be cautious when you invest in a venture capital firm. The rule of thumb is that you want to be investing at least in 3 subsequent funds if you believe that they're going to do well and that manager is successful, that they will return money and that you will get a risk-adjusted return on your capital. So be very careful before committing money to invest in a VC.
Yeah, I'll just take that a little bit differently. I think yes, VC did have, I think, a sort of maybe a 10-year rough period from sort of the mid 2000s to the early teens. But at least as of this year, VC will have blown away all private asset classes, including PE, which has had a huge run, and that blowing away performance, I think, sort of is probably here to stay for a bit. And this is sort of one of the things that when I said 30-year shift and sort of what is ahead is going to be very different, I'm one of the believers that I think the scale of VC-backed companies is only going to get bigger and bigger. So I do think that there is a huge amount of wealth creation ahead for this venture class, which includes obviously the technology companies, startup ecosystem underneath it. So I have a slightly contrarian view. Yes, VC has had a damp 10 years in the middle, but it was a very strong asset class, way stronger than PE prior to that. And it's come back roaring. Specific to you investing in an asset class, it is the only way to get you should look at it as an asset diversification. So, it's not a substitution for however your allocation may be. But if you do have access to VC investing, that is the only way to get access to private market wealth creation. So it's VC, it's VC or PE. So like Ashmeet said, it has its own risks. So you have to sort of evaluate the risks and invest accordingly, and then choose your managers carefully, and then stay with that manager for a few funds so you get a return across the funds.
And this is what makes investing in general and venture capital so fun, that you can have 2 people with, a different take on the exact same data. So both of us are analyzing the same data. I do agree with Nilanjana that there is a structural change in venture, and we will see massive wealth creation across the asset class. I do believe that is true. But I still continue to believe that an individual venture capital investment is a very high risk investment and should be approached with great caution.
So one thing I wanted to ask the audience to please have your questions coming, because based on that, I'm timing things. So Nilanjana, it's time for you to take on the next myth.
The next myth is VCs know and can give you good operating advice. I think we've been talking about this for a while now. A VC's full-time job is to invest in companies. It is not to build a company. So if that is sort of a big area where you need help, the VC is not building a company on a day-to-day basis. So they're not in the weeds of hiring people, managing people, executing on sales and marketing strategies. And it is very important to surround yourself with experienced operators to get that help if that's what you need. On the other hand, the VCs are probably much more current on certain things than any one operator, no matter how successful. And those are certain areas like the most current, sales strategies, the most current marketing strategies, because they have a very broad perch. They're seeing a lot of business models. They're seeing what's succeeding, what's failing, and what's most cutting edge. So yes, don't expect them to give you the day-to-day operating advice, but do listen to what they have to say on certain strategic initiatives, because they have an unbeatable perch, and that input could be very valuable to you.
Yeah, again, I think Nilanjana does a great job of framing, the way VCs look at the world, which is fundamentally different from how entrepreneurs look at the world. They have this broader view. It's an inch deep and a mile wide, as compared to an entrepreneur who is hopefully a mile deep and perhaps a foot across, not an inch across, right? I mean, that's what a great entrepreneur is, if you can get to that. So here's what I would add to what Nilanjana said. For various reasons, which is not interesting for this conversation, VCs tend to hire great operating executives as partners. There are certain reasons why that can make for good investing background, including the ability to help you, including the ability to give you advice, but also to make great investment decisions. I believe operating experience helps you to be able to do that in many interesting ways. And so that's why it's a little confusing when someone with that sort of background says something. It should be evaluated from the lens of an inch deep and a mile wide. So I used to run product management for ESX Server at VMware. It's a huge product. It became a massive success, billions of dollars in revenues. I was there when we had zero revenues. I was there when we had 1 million in revenues, when we had 100 million in revenues. I've seen that journey. And I was running it and I was watching it. And so I may have some perspective or some opinion on that. That's one place where I have depth, but I was not at Facebook. I was not at Google. I was not at Arista. And those are also very interesting stories and a lot to learn from them. Fortunately, now we are a big enough ecosystem that you can read about it in blogs, on Twitter. You can hear about it in podcasts. You can read about it in books. There are lots of books that are published. And there's just a lot to learn online. And so the secret of Silicon Valley is now no longer a secret in terms of how these companies work. Because the secret has always been 99% hard work and 1% luck. And so, that secret is now well understood. You have to work hard if you're going to make it successful, and take operating advice. I can share facts about, our relationship on the cloud and Microsoft. And, I can tell you stories about how decisions were made by Apple, which may be instructive for what you are doing, but it's not gospel. It's not the be all or the end all. Just because I'm on your board, just because this person, was part of a company which today has 10,000 employees, well, maybe they were only 1/10,000th of the contribution to the success of that company. So you never know. So just be careful when you take operating advice from a VC.
So, Ashmit, it's time to move on to the next myth. Looks like we won't have time. So please take the next myth on.
Okay, so this last one is really important, especially here in California. Because, in California, we have this culture of being laid back, of everyone, this is famously where if you wore flowers in your hair and came to San Francisco, you would find love. For those of you who heard the song by Scott McKinsey. We do have a style, we do have a culture in California. I mean, we invented, the informal working style, the HP way. If you go back to the very roots of Silicon Valley, my first job, I was an intern at HP, and I remember reading a memo about women being allowed to wear pants to the office and not having to wear skirts, and they were the first Fortune 500 to do that, believe it or not. So this was part of the mythology of HP and the history of HP when I joined them. Was that, we invented this way of MBWA, management by wandering around, which is the essence of entrepreneurship. It is the essence of innovation, and it is also how venture capital works. And venture capital has leveraged this because it's a relationship business to always appear to be your friend. And so sometimes people will get confused that the VC is really your friend. Again, going back full circle, the VC is your investor. The VC may be there to provide governance on your board. The VC may be there to provide advice as a partner in the company. The VC may be your competitor. The VC may be investing in your competitor. So they may be they may be your student. They are learning from you to apply it to a different business in which they're going to go and apply. So be careful. There are many roles that a VC can have. They may appear to be your friend, but they are not necessarily your friend. It is a professional relationship, and so you should understand that.
Yeah,
Sanjana?
well said, and not much to add to that. It is, again, role clarity. We are going back full circle. I think just be very clear about what your role is, what the role of the investor is, and how the two fit. Having said all of that, I must say that these are seldom short journeys. More often than not, they are long journeys, and you're sort of tied at the hips with the founders, and especially as the first check, and it's their baby. I am probably more of an empathetic investor, and many of the founders, regardless of outcomes that I have backed over the years, have become my very close and dear friends. So good things do come out of that relationship, but principally it's a business relationship in the office, and you have to remember that, and we have to remember that.
And let me underscore that by saying that it can be a very positive relationship. One of the things I'm very proud of personally is that I have backed founders multiple times, and they have come back to me for their first money again and again. I have multiple examples where when the second time they were doing a company, they would come back to me and say, hey, I really want to work with you again. And these are founders who had worked with many other firms. They had a choice. The first time, it's a lot harder for the entrepreneur because they have less information. The second time, they are actively choosing you. And that's one of the things I am most proud of as a VC, is when they have come back to me and taken money from me again when they had a choice to go to many other people. So yes, it's a relationship business. It can be a good business. And some of my former entrepreneurs are my best friends, my neighbors, even richer than me. They've been very successful. So all of those things are true, but understand the nature of the relationship. If there's one takeaway from today, that's what I'd want you to have.
Nilanjana, any last words? And then we need to, unfortunately, close the session.
No, it's wonderful to be on an IIT alumni panel, and looking forward to working with some of you and perhaps many of you. So do reach out if I can be helpful in any way, and looking forward to continuing this journey.
Ashmit, anything from you?
No, Birur, I think I appreciate the way you moderated it and weaved it through. Really nicely done, and I enjoyed being here. I'll say, if anybody wants to start a company, give me a call, especially if you are an engineer with a technical insight.
So thank you both. Thank you, everyone. So it's time for us to move on to the next subject.
Thank you, Ashmit, Nilanjana, and Vidyut for that valuable discussion. A lot of busting of those myths. Those are quite a few, and some great tips on how to navigate through those circumstances as well.